Thank you for joining me for this presentation. My name is Brad Renard. I'm the Chief Investment Officer of QTR Capital Management and also for Upside Options, a sister company of QTR Capital. Today is Monday, May 6th, 2019, and the objective of this presentation is to give you a market update with 3 to 6 month projections and our thoughts on the best investments for 2019. The questions that we'll try to address are: how is the economy doing? Is it still slowing? How's Q1 earnings season going? It's about 78% complete right now. Where's the stock market going next? What will be the best investment strategies in 2019? Passive versus active stock picking versus a non-directional strategy such as Iron Condor Pinnacle. Should I trust my financial advisor with all of my money? And when is the next recession going to hit? And just a reminder, when sessions do hit, they usually hit the stock market by minus 30 to minus 50%. The strategies that we offer, and I'm just going to cover 3 quick slides on what we do, and then I'll jump into the charts and we'll start talking about the overall market. We offer non-directional income generation strategies and long-short quantamental strategies that blend technical, fundamental, and quantitative analysis. So we have a big cap growth strategy. That's stocks above 10 billion in market cap. We have a small cap growth. That's for focusing on stocks 250 million to 10 billion. We have a contrarian strategy, focusing on stocks that have been out of favor for 6 to 12 months, and they're starting to recover. We have a sector rotation strategy that concentrates in strong stocks within the strongest industry sectors. And we have Iron Condor Pinnacle, and I'll spend a few more slides on Iron Condor Pinnacle. This is a conservative, non-directional income-generating strategy that uses weekly index credit spreads and Iron Condors. Our differentiation: we do 4 levels of analysis. It's called 4-level quantamental analysis, where we're blending technical, fundamental, and factor-based quantitative analysis. We do long short. We follow strict exit rules. We're able to let most winners run, but our exit rules are fast enough where we can lock in gains, whatever gains that we have, to protect capital. So for example, in 2018, we went from 75% allocated to 15% allocated in about 6 days, when the market just started to roll over hard and actually dropped about 20% after that through Q4 of 2018. So for 2018, we finished off the year with plus 14% to plus 18% gains with our strategies, where the benchmarks, they actually closed the year out at minus 8 to minus 12% gains. And our strategies are managed by traders that are nimble and fast moving. We follow exit rules decisively. Our differentiation, just one more slide on our 4-level quantamental scanner. We start with a top-level macro analysis. We're looking at big picture, technical, breadth, fundamental, sentiment, and that modulates our bullish and bearish exposure levels. We then do a technical scan to find high probability setups in stocks. We then do a fundamental screen. We're looking for strong or weak companies, strong companies for the bullish trades, weak companies for the bearish trades. We then do a quantitative screen, which gives us probabilities of the pattern following through, either to the bullish side or the bearish side. And then finally, we use technicals to trigger our entries and exits. Just 2 slides on Iron Condor Pinnacle, and then we'll jump into the market analysis. So for characteristics of Iron Condor Pinnacle strategy, it's a non-directional income generating strategy. It's a conservative implementation with capital preservation and safety as a top priority. The targeted returns for this strategy are about 2.5% to 4% per month after commissions. We hold a maximum of 3 call spreads at any one time. That represents 30% exposure of the portfolio. And each position represents 10% of the portfolio and is open for 2 weeks. So for example, for a $10,000 portfolio, each trade holds $1,000, representing 10% allocation. And for the put spreads, we underweight the put spreads, holding a maximum of 2 put spreads at any one time, representing 20% exposure of the portfolio. So this strategy is conservative by construction, allows us to sleep well at night, but it's still able to generate excellent monthly returns. And it generates cash flow for the people who need the monthly cash flow. This is a risk-reward graph for an Iron Condor, and I'll briefly cover it, and then I'll give you a link that you can go to for more details. This represents a risk-reward graph for an options trade. This represents over here gain or loss of the trade. This here is the index, and for example, I'm looking at the Russell 2000 index. This is an old chart as of November 25th, 2005. This index closed at 680, and what I'm doing is I'm selling a call here and I'm buying a call there for protection. I'm selling a put here and I'm buying a put there for protection. So in this case, I'm selling the 740, 750 call spread. I sell the 740 call, I buy the 750 call. For the put, I sell a 610 put. I buy a 600 put for protection. The two spreads create an iron condor. Both spreads bring in a credit of about $1 or $100. The trade holds $1,000 of maintenance. So the potential return is $100 divided by $900 of risk because we brought in $100 of credit. So the risk is only $900 and the potential return is 11%. And the objective of this trade is we want the index, in this case the Russell 2000 index, to stay below the short call that we sold and to stay above the short put that we sold over a 2-week period. And if it does, then it will settle 100% profitably and we'll keep the $100 of premium that we collected for this trade and we'll book 11% gain in about 2 weeks. And these are the types of trades that we open up in Iron Condor Pinnacle. So for more information, please just go to the upsideoptions.net website and go to the Learning Center, and you'll see more information on iron condors and credit spreads. Okay, let's jump into broad market analysis. For a snapshot of today's market, as of early May 2019, the U.S. economy has been slowing, but it looks like the slowdown will be transitory. Corporate earnings are slowing. We're currently sitting at minus 0.8% growth for Q1 earnings and projected to be flat for Q2 19 earnings. But overall, for corporate earnings, they're a little better than what analysts were initially expecting. Recent jobs report was good, so that's good news. Most economists project about 2% growth for 2019, so that's good. Overall, low chance of a recession in 2019. However, with that said, 70% of CFOs believe we'll be in a recession by mid-2020. We have continued negative surprises on the economic data being represented through the Citibank Economic Surprise Index, and I show that chart in this presentation. A yield curve that is still flattish and recently inverted, so the bond market still projects a slowing economy in 2019. And a reminder, a slowing economy and going into recession is a gradual process, not an event. It takes many quarters to unfold. And as a reminder, recessions usually cut the stock market by minus 30 to minus 50%. The overall market is slightly expensive. We're trading at 17.3 times forward S&P 500 earnings. We have continuous political uncertainty that can sell off stocks at any time. And unfortunately, as I'm making this recording Sunday evening on May 5th, the Dow futures are down plus 500 points on a tweet that came from Trump on China trade. And overall, a volatile market, especially in 2018. And just like what we're going to see this week, with China trade, it's difficult to navigate and it's difficult to generate consistent positive gains using stocks, ETFs, or indexes. So let's look at the charts. This is the S&P 500 index. This is a big picture weekly index. On this particular weekly chart, each candlestick represents 1 week of trade. We go from 2011 up to present. I show a 17-week exponential moving average and a 43-week exponential moving average. In general, when the 17 is above the 43 EMA, it tells you that the market's in a long-term confirmed uptrend. Whenever the 17 crosses below and starts getting choppy, it tells you that the market is in a transition point or could be in a confirmed long-term downtrend. This was really ugly. This was a lower low here. This was an earnings recession. For 5 straight quarters, the companies were not generating earnings. It finally shook it off. President Trump was elected. We can see that this market then trended higher in anticipation of pro-business initiatives, tax cuts, and infrastructure building. 2018 was very ugly. 17 crossed below the 43 temporarily, got back over it. We had a V-bottom bounce. We're back up near the highs. Here's the daily chart of the SPX. This is zoomed in a little bit, so we have 2017 here. Here's all 2018 and where we are right now in 2019. This is on Monday after Trump's tweet on Sunday night. The market was, the SPX futures were down over 60 points Sunday evening. Market did sell off, but it actually bounced back a little bit. So it's actually trying to hold around the 2,900 level, and we'll see what it does this week. There is a reasonable chance that this SPX is going to retest 2875. This is the NASDAQ Composite. This is on Monday, May 6th, so we had 1 day after Trump's tweets with regards to the China tariffs, and we can see that it's kind of holding. So the NASDAQ Composite could pull back farther and down into this channel sometime this week as we're trying to figure out what's going on with China trade. Here are the Qs, NASDAQ 100 of the largest, mostly technology stocks. This one broke out a couple weeks ago, and it looks like it's still holding above breakout. So this is good. We'll see how it behaves this week. Mid caps, they're looking better. They were underperforming. They bounced back, but they found a lot of resistance around the 200-day line and this resistance level. So we're above 1936, and we'll see how it does this week now with the problems around China trade. IWM, small caps. Actually, on Friday of last week, it just popped over this resistance level. This market was perfectly set up to start climbing into new territory, especially with the small caps now participating. Small caps sold off this morning, but they actually bounced back, and we're back over this 160 level. Like all the other indexes, we have new issues now this week with China trade. We'll see how the market behaves. The interest rates on the 10-year Treasury, we can see that they fell. Money flowed into Treasuries, and we're down to about a 2.5% rate. When we're down to this level, we're practically inverted on the yield curve. We're just still very flat. This is not great, and the bond market is telling investors that the U.S. economy is going to slow over the next 6 to 9 months and is not in agreement with the equities market. This is the spread between the 2 and the 10-year Treasury yield, and we can see that the spread is about 20 basis points between the 2-year and the 10-year. In general, a flat to inverted yield curve is not good, and it tells us that the bond market believes that the economy is going to slow. This actually summarizes the yield curve a little more. For example, this is the S&P 500 index here. This goes all the way back to the 70s, and this represents the slope of the yield curve, the difference between the 10-year note, interest rate of the 10-year note, and the interest rate of the 2-year note. And we can see that every time that the yield curve flattened, sooner or later we went into a recession. And that happened again in 2008. You can see where the yield curve, this little area, represents a negative or inverted yield curve. And now we can see where we are right now through heading into 2019. High yield corporate bonds, HYG. This represents triple B quality bonds or less, and it did rebound. It tells us that investors are comfortable in the quality of the debt that's being issued by companies. So right now this is okay. Here's the chart of the VIX. This represents volatility or fear in the markets. We can see today on Monday, after Trump's tweet on Sunday night, volatility popped up. It actually went as high as almost 19 and then pulled back. In general, volatility has been low. We can see the 13-day EMA is below the 50-day EMA, and all of this is below the 200-day SMA. So it tells me that volatility is, in general, very low, and there's not a lot of fear in the markets. We'll see how this behaves this week now with the new fears around China tariffs. Here's the dollar, strength of the dollar versus other currencies around the world, and a strong dollar is good. It tells us that investors believe that the U.S. economy is in good shape. We just don't want the dollar to get too strong. Here's Europe. These are Europe financials. We can see that Europe was pretty much on a downtrend for the last year. Looks like it's found a bottom. It's back over its 200-day line. So this looks good. Here's EWG. This is Germany. Germany's back over its 200-day line. That looks good. Let's look at some of our sectors. This is XLF, the financials. We can see it bounced back over this 200-day line. That's actually pretty good. So we need the financials and the banks to participate in order for the market to be healthy. So it looks okay. We have a pseudo-flat yield curve where it inverted several weeks ago. So that was not helpful for the financials or the banks. But right now the yield curve is back to being upward sloping and the financials are okay. Industrials, XLI, looks pretty good. Over the 200, 50's crossed up through the 200. We're up in this channel up here. This is pretty good. Technology, XLK. We can see it just went straight up. So this is where a lot of the money went, broke up to new highs several weeks ago, actually about a month ago. And it's a good sign for the health of the stock market. The Dow Jones Transportation Index, we can see it looks pretty good. Back over the 200-day line, 50's crossing up through the 200-day line. So that's good. Health sector, this one's getting hammered. Because of the Democrats now taking over the House, they're making a lot of noise around expanded Medicare and lower drug prices. There's a lot of policy risk now in pharmaceutical stocks and healthcare stocks in general. So we have to be a lot more careful with this sector. ACWX, this is all world, less US, and we see that stock markets around the world are doing pretty well. So that's overall good for US stocks. Looking at a few market breadth charts. This is the cumulative advanced decline line for the NYSE composite. This is a decent leading indicator. And advanced decline line is basically the number of advancers each day minus the decliners for that particular day. You end up with a number, whether positive or negative, and then you keep on adding that number together day after day after day. You end up getting a cumulative advanced decline line. And we can see that breadth indicator is still pretty bullish. For the NASDAQ Composite Index, which has about 2,500 stocks in it, we can see that this one is also pretty bullish. Money continues to flow in, where on an average day, more stocks are up versus down. Cumulatively, you can see that this is telling us that this is pretty bullish. Earnings. This chart represents the S&P 500 index and its forward 4-quarter estimated earnings. And right now, analysts are estimating about $173 of earnings over the next 4 quarters, and that represents this black line right here and this y-axis over here. So we're at about $173 worth of earnings. The blue line represents the S&P 500 index. For Q1 19, which we're about 78% complete, corporate earnings growth is sitting at about a minus 0.8% growth. This is the first negative number that we've seen in a long time. Now, sales growth is sitting at plus 5%, so that's still pretty good. And corporate earnings growth is projected to be flat for Q2 19 also. So right now we're about flat, we're slightly negative. We're supposed to be flat again for another quarter. We'll see how the market digests that. Economic data. We just had a non-farm payroll report that came out last Friday, and it was really good. So we generated about 263,000 jobs. The unemployment rate dropped to 3.6%. Non-farm payroll change, you can see what it looks like over the longer run. This is from 2011 through 2019, and you can see that it's been very steady. This is pretty good. Not bad at all. Hourly earnings look good. People have more money in their pockets, and it's not driving up inflation. Usually this would drive up inflation. But so far with globalization and technology, inflation has been very benign. Non-defense capital goods orders, this represents business spending. This has been rolling over a little bit, but we just had a half decent number at the last report. So it's still okay. ISM index, this represents manufacturing across the United States. If it stays above 50, it tells you that manufacturers are expanding in their production, and we're still over 50. But it has been rolling over a little bit. Retail sales has been okay. It was weak for a couple of months, but we just had a good reading most recently. And personal spending. This is highly correlated with retail sales, and it really popped recently. So this was a strong number. On the negative for economic data, we have the Citigroup Economic Surprise Index, and this one has been rolling over. It's been basically telling us that at an aggregate of looking at all of the economic data coming in day after day after day, we're getting more surprises to the downside than to the upside. So this is something that we have to watch. GDP Now, this is a real-time estimate of GDP growth, and this comes from the Atlanta Fed, and they tend to be pretty accurate with their projections. And this has been recently downgraded. They were way up here in the 2.7% range until just this week. Now they're down to the 1.7% range. So what they're saying is that for the next 6 to 9 months, they believe GDP for the 2019 is going to be closer to 1.7%. So questions to address after looking at all these charts. How's the economy doing? Well, there's a low probability of a recession in 2019. Most likely we're going to have steady economic growth of 2% to 2.25% through 2019. How's earnings season going? Well, we'll probably have another quarter of flat earnings growth, but investors are betting on a rebound in the second half of the year with better earnings growth. Earnings growth ultimately drives stock prices, so we do need earnings growth, and I think the market is going to be okay for 1 or 2 quarters of flattish earnings growth, but I don't think the market is going to be happy if we have more than that. Where's the market going next? Major indexes are breaking out, and they will probably hold above breakouts. Unfortunately, again, I am giving this presentation Sunday evening on May 5th, and the Trump administration just sent out a tweet with regards to possibly increasing China tariffs, and the Dow futures are down plus 500 points. So I think this week could be ugly, and we're going to have to wait until we can get through China before these indexes can actually hold above breakouts, because everything was just perfect as of Friday. After the good jobs report, all the indexes broke up through. Everything's looking good. Most likely we're going to grind higher and hold above breakouts, and now that's not going to be the case again. And they're going to fail for the second time. So once we get through the China tariffs, investor sentiment should be positive, and that means that the high quality stocks most likely will continue to move higher. and you can make money with those. What will be the best investment strategies in 2019? For the indexes, we have minimal upside potential for passive buying of the major indexes. So for example, let's say the SPX does hold above 2930, which is its breakout. Well, the next target is 3000. The highest targets I've seen are 3100 by analysts and some money managers. So if we get up to 3000, you can make 2%. And if we can get up a little higher, you might make 3, 4, 5%. So you don't see a lot of upside potential of just buying the indexes. So that's really not recommended. You could get higher returns if you rotate in and out of sector ETFs. That could possibly work, but that takes more work and it's not easy to do. Non-directional should do well in 2019. For example, our Iron Condor Pinnacle strategy, where we're selling and bringing in premium every 2 weeks on trade. So we're selling calls and selling puts in a very conservative manner, and that generates 2.5% to 4% per month. So the non-directional should do pretty well in this market. Stock picking of fast-growing companies with momentum should do okay. And don't get greedy. In our opinion, start to book profits once you start getting 10% gains or more in your holdings. And one last question to address. Should I trust my financial advisor with all of my money? Well, they usually just buy the market by purchasing passive ETFs, usually the indexes. And right now there's minimal potential gain with passive indexes. For example, if the SPX stays above breakout and grinds up to 3,000, there's about a 2% gain there. There's a lot of risk and not a lot of gain for just going passive. Financial advisors are not well-trained chart technicians. They don't implement strict exit rules, and they're not trained to exit positions quickly. Their job is usually just to stay long the market so they can hold on to your assets. And they do well when the market trends up, like it did since the Trump win in November 2016 through early 2018. And most financial advisors will hold you right through a recession. And when you call them up and ask about your money, they'll just say, it's best to just hold on as it will eventually come back. We don't play that game and we don't agree with that. So we know how that played out in 2008 when most accounts lost 40 to 60% of their value and were drawn down for 2 to 3 years. So some questions to ask your financial advisor. Will you ever take my account to cash? How much do I need to lose before you start going to cash? And would you consider outsourcing some of my cash to a third-party investment manager? Some financial advisors do that because they're very busy. They're doing lots of things. They're meeting with clients every day, and they're not really portfolio managers. So sometimes it's best for the financial advisor to outsource some of the cash to professional portfolio managers who do that full-time as a living. And thank you. Thank you very much for watching this presentation. To view this weekly analysis in its entirety, please go to the UpsideOptions.net website /weekly market update. And here's some other additional contact information: UpsideOptions.net, QTRcapital.com, or support@QTRcapital.com. Thank you very much, and I will see you next time.